agora, chamo aqui ao palco a terceira keynote speaker, professora Shari Loessberg.
Okay. So while we're waiting for my slides to magically, look, there they are, to magically appear, I want to assure you that, in fact, you're right, and I am part of Team Mangueira. All right, I have a slide deck. I have the right clothes on, so we're going to spend about 30 minutes talking about money and investment into startups in Brazil and Latin America. They gave me 30 minutes, but I want you to take 10% of all of my time, and I want you to turn to your left or your right or in front of you or behind you and meet somebody new. And I have 3 reasons for you to do that. First one is because it's kind of fun and because it's late in the afternoon and you're running late. No, hold on. But I also, okay. You know what? You want to visit, you go ahead and visit. And in 3 minutes, I'll tell you why you did it, okay? 3 minutes, and I'll come back. Go. Talk. Okay. About 30 seconds. 30 seconds. Wind down your conversation. 20 seconds. Wind down your conversation. That's great. Okay, so do you know why we did that? 1, because it's fun. 2, because I am nuts about the importance of networks and connections. Yes, thank you, and I'm glad you've met your new best friend. I also think it's important for us to say out loud, we couldn't do what we just did for 3 years. It's nice to be together again, isn't it? Okay, so I hope you met somebody interesting, and now we're going to just walk through some less fun stuff. Because if you're an investor in Brazil or in Latin America or pretty much anywhere around the globe in early stage technology companies, it's a rough time right now. If you are an investor, you don't need to see this chart. You already know what it looks like. But I know there are plenty of you who come from other parts of the ecosystem here in Rio and Brazil. And while the drop-off in investment from 2021, which was either an outlier year or a bubble, whatever language makes you more comfortable, it's important to note that, right, it's about $1.5 billion. Well, if you go back to 2020, $1.5 billion is roughly the same amount that was raised on a quarter-by-quarter basis just a couple years ago. So it's not that Brazil is driving off a cliff, although it kind of feels like it right now. It's that the aberration, the bubble of 2021, is over and a necessary reset is happening. Oh, and we'll talk a little bit about debt and whether that's a good thing or a bad thing. Here is just some sad headlines to kind of add to the downside. This big chart is about we've lost 35% of all of global venture capital. It's not just what happened in Latin America. And I think unfortunately, there's an extra slide that was supposed to be the only one that you were seeing, but you can read it again because it's equally sad in a slightly different order. Up at the top, this layoffs number, this is new information, and it's an additional element of the pain that the downturn represents. It's not just resets in valuation. It's not just paper billionaires turning into paper millionaires. It's human beings who have lost their job. And in the venture capital world, it's also worth saying out loud, FTX. FTX, anybody in the room know about FTX? So FTX is a crypto company that scaled and scaled and scaled. They raised over $2 billion in venture capital, right? Which is more than all of Latin America did in several quarters. And in a span of virtually hours, right? Less than 2 weeks, it went from market cap exceeding 30 billion to zero. Alfred Lin, who was the #1 tippy-top venture capitalist on something called the Midas list that Forbes magazine puts together every year to talk about the best venture capitalists in the world. Alfred Lin was tippy-top in 2021, and in 2022, he told his firm, the storied Sequoia Capital, right, the fanciest, most famous venture capital firm in the world, to write down their $200 million investment to zero. He is not #1 on the Midas list this year. So venture capital has had a hard run over the last 12, 14 months in Latin America and globally. None of the items listed up here are a surprise to you, whether your business is in technology or you are an old school manufacturer. These large macro conditions are affecting the global economy. So if we come down and look at what's going on in your backyard, what does that really mean for the startups you want to support? Well, it's all about cash. It's all about conserving cash, maintaining burn. It's all about unit economics. No one is preaching blitz scaling or growth at all costs anymore. Valuations, surprise, surprise, have been reset, and there will be more resets. Resets down from the stratospheric heights in 2021 to some very, very hard down rounds or lower valuations the next time those companies go to raise money. Deal terms, right? You have to figure out the legal bits when you raise a big bunch of money, and the legal terms have gone from being very, very entrepreneur friendly. Whatever you want, and I'll give you the money tomorrow by breakfast, to swinging all the way to the other side, and now many more protections for investors. Not only do they get better valuations for them, meaning lower, they also get more protection against any kind of bad stuff that may happen in the future, pushing risk of continued low valuation back over to the entrepreneur. So it's kind of a good time to be an investor, especially for making new deals. The IPO window is closed, and that just means that one particularly high-profile form of exit, which means investors get paid out, as well as entrepreneurs, is closed and will be for the foreseeable future. On the other hand, consolidations, just meaning smaller firms coming together to merge into one survivor, or acquisitions, where a larger company, an incumbent, some of you who are coming from old line legacy corporations may have wonderful opportunities to pick up great technology, great talent at very attractive prices. But it's important to note that there are a lot of companies operating today, January 2023, that will go out of business and cease operations by the end of this year. And that may continue well into 2024. Now, there's a little bit of good news. Most everybody in this room is really focused on the transition away from carbon, and therefore interested in that next stage of innovation and the talent and the startups. And so at this seed stage, this early stage, deals have been less hit. They've been most hit hard at the latest stage. And this means big, large companies that traditionally would have gone public, would have had an IPO and floated their stock on public markets. Because there was capital available to them from what we disparagingly call tourist money, which is, could be hedge fund money, could be private equity investors, folks who do not traditionally invest in the venture capital ecosystem. They decided, oh, you know what, the opportunity is too good, we're coming down market to earlier stage companies. We're going to provide that money in a private round so you don't have to go public. Well, it seemed like a good deal while the party lasted, and surprise, surprise, the party has ended. And so all of those tourists have all gone home. And there's a cost to that, because it means some of that late stage, some of that growth capital that Latin America was really able to take advantage of, in particular SoftBank, right, has pulled back. And so there is a flight to safety. And by that, I simply mean that many of the folks whose day job, whose comfort zone, whose expertise has historically been in other areas have all left. Folks, and it's not just on the investor side. Do you guys know this word? This is a hard one to translate. Wantrepreneur. A wantrepreneur, we say, is somebody who is doing a startup because it's cool, because they saw it in a movie or on a TV show, or it shows up in their feed, and so they're going to be an entrepreneur too. They want to be an entrepreneur. But we all know the best entrepreneurs are the ones who are so passionate, who are going to run through walls because they don't care what's going on in the macro market. They just want to build something. And so they're not fleeing to safety. And I look at some of the sophisticated investors in this room whose day job is to be a venture capitalist. And they're not fleeing for safety either. They recognize that there are good opportunities now, and they have the experience and the sophistication to wait out this rough patch. Looking at you, Hisha. So sophisticated investors see it, and I just want to give a shout out to the not wantrepreneur, the true, passionate, committed entrepreneur who only wants to go out and change the world. Every one of those companies up on this slide was founded either during a depression, a recession, or a financial crisis. They weren't thinking macro, they were thinking, I know how to make the world better. And it's not just 100 years ago. all of these companies, every single one, was founded during the great financial crisis, 2008 or 2009. And to be fair, there was also fundamental innovation in technology that empowered a lot of that, right? Because the iPhone was launched in 2007. But those folks chose to build at one of the most precarious times in recent financial history because they believed they could make the world better. So it's easy to stand up here and wear pink and green and tell you it's all going to be better. I want to acknowledge that every single job that becomes a layoff statistic is somebody who has to worry about making rent or putting food on the table or finding that next job if there is a domino effect and other companies go out of business in their sector as well. It's a time of great stress and anxiety. And it's easy to paint the big picture and say, yes, SoftBank has pulled back and so expansion capital is reduced. But there are hundreds of thousands of individuals working in the technology sector in Brazil and across Latin America who are directly impacted by this washing out of the tourist. And bearing that in mind as we talk about the big macro changes, I think is also worth saying out loud. And my day job is to think long and hard about emerging markets, and I'm lucky enough to teach about emerging market venture capital and entrepreneurship. And so the first time I came to Rio was in 2002. And I was working with a group called Endeavor, which was itty-bitty and about this big. Anybody in the room ever heard of Endeavor? Yeah. Okay, so they're a little bit bigger now. But as I came to the Museum of Tomorrow today, which is beautiful, I got out right next to a spoleto. So spoleto was also like this big back then. And sometimes it's easy to forget just how much in a generation your city, your country has changed. And I was talking to Danusa, the communications person who is working with us here on our conference this week. And she talked about the stray dog syndrome. And she told me that sometimes Brazil still has the stray dog syndrome, which comes from a famous writer in Brazil. And I said, how interesting to hear that from you as a Brazilian, because you know, from where I sit, every student I have who comes from Indonesia or the Philippines or Chile or Peru is always looking to see, so how is Brazil going to react? What did Brazil do? What do the regulators look like? How did you bring in venture capitalists? How have you made the changes that have allowed the ecosystem to grow as rapidly as it has? So, for me, I look at three things. The first one is just, I'm going to quickly highlight. If anybody wants to talk more about it, I love these things, and I'm happy to talk with you about them. The alternatives to VC, different ways of accessing capital, because venture capital is not right for, not right for most startups, it's right for a very small slice. Over 98% of all companies around the world do not raise venture capital. That shouldn't be a surprise, but sometimes it feels like it because everybody is raising venture capital. So we need more and better alternatives to venture capital. And I think there are some that are a good fit for the Brazilian market. The next one is plumbing. I'm a big believer in plumbing and infrastructure. the enabling environment. And then the last one is to just mention mafias. So tech alumni groups that go from one big startup to another, continuing the networks and community that they've built. So, first one is about corporate venture capital, which doesn't seem like it's an alternative, but it can be, right? Depending on how the CVC is structured, there can be a lot more fluidity in how patient it is. My colleague Lars Froland was up here talking about Brazil should think about funds that can be more patient capital with a longer time horizon to exit. And I think that corporate venture capital can also fill some of that role. There are an awful lot of interesting structures and innovations in structures that I like to come to Brazil to learn about. So I look to it for one piece of the solution to VC alternatives. And then the next one, I was just talking to this great guy from FinUp outside in the hallway where it was just as noisy, and he said that, and he agreed with me as a great approach for the Brazilian market. So if you're not familiar with revenue-based investment, which sometimes is called revenue-based finance, the idea is it's like a royalty. You know, like royalties in intellectual property or in oil and gas. It's not a loan, it is an advance of of expansion, growth capital, not working capital, for firms who then agree to repay not a loan fixed amount monthly, but a percentage. Whatever comes in to me, I will pay you 5% of each month until I repay the entire amount, plus whatever premium we negotiate and agree on. That's a lovely model. Now, it doesn't work great for really, really early stage firms. Ideally, it's a firm that has regular, recurring revenue. So like a SaaS company, a software as a service, subscription-based model is ideal, right? With that predictable revenue stream, take that little slice off of it monthly and pay it back. Because when you pay it all back, guess what? Your investor is gone forever. You have not given away some meaningful chunk of the ownership of your company. You do not have them sitting on your board forever and ever and ever. It's a lovely alternative. And for the right profile, many of which companies are operating in Brazil today, it's a lovely option. And some of you probably know A55, which I'm sure is not called 855 in Portuguese, but those guys just raised, I think, 27 million a few weeks ago to be participants playing in it in Brazil today. So it's out there and it's growing. We have billions of dollars being deployed in the US, and in Europe, it's actually taken off even more. Plumbing. Quickly, I just want to say, and how long do I have? I'm finished with time, but I started late, so I'm going to finish this quickly, okay? Because I want to get you guys back on schedule as well. On plumbing, I just mean the infrastructure. I mean the enabling environment. Think about, right, 20 years ago, who in this room had a cell phone? What does internet penetration look like today? Think about all of the regulation. Think about the sophistication of your regulators. Think about the money, the venture capital that has been raised. None of that is going away. It's a lousy time right now. It's the bottom of the cycle, and it feels crummy. But all of that infrastructure, payments has been solved on the internet in Brazil. And that will be forever. The ability to transact commerce on the internet has changed the face of Brazil forever. And that's a done deal. It's an accomplished fact. So, I love this slide, so I always show this slide. When somebody asks, are the good times over? I say, no, tactically, we have alternatives to VC, which we can grow. And systemically, we have this cool accomplishments in infrastructure, right, in the plumbing. But most importantly, you guys have the mafias. And by mafia, I mean the tech alumni startup groups, right? Look at all of these white guys who went on to do extraordinary things. Peter Thiel and Elon Musk and Reid Hoffman. Say whatever you think, whatever you want about them, but they have built extraordinary companies, right? And they are in touch with each other. And they've gone on to become investors, mentors, coaches, and entrepreneurs. Airbnb, this is one more example, right? This is over 100 different startups over a 4-year period from the founding group at Airbnb. They raised $1 billion in a few years, relying on one another, connecting to one another, and leveraging their networks. And here, let me go over here. So look, it's not just in the US. Flipkart is a really, really big company in India. Gojek and Grab are huge in Southeast Asia, Malaysia, and Indonesia. Andela is in Nigeria. Shopify comes from Canada. Careem is in the Middle East. HubSpot is in my own backyard. Yeah, they're actually an MIT mafia, yay. And here, look at all of the startup mafias that exist inside Latin America. I'm going to go next door and talk to Argentina because I love this. This comes from Endeavor, and that was one of their early social graphs, right? It started out, some of you in the room remember the early days in Argentina and what they were able to build. And now so many of those folks are on the other side. Some of them are still running Mercado Libre, which is a good day job if you can get it. But also they've built the largest venture capital fund across Latin America and one of the largest fintechs. So as they've grown, they've connected in different ways. Here's the last slide. Thank you. It is all about the networks. It can only be about the networks after you've done the plumbing, you have the internet penetration and the consumers who care about your technology. After you have built out the venture capital funds and attracted the global investors. And last and most importantly, after the people you have persuaded to join the internet, the digital revolution, to become part of your entrepreneurial ecosystem. So I'm going to conclude and say, for entrepreneurial ecosystems who have a robust set of components up here, as I would argue Brazil does, rebuilding the next time around is going to be much quicker. And hey, I want each of you to do your part. So remember that new connection that you made? You go enrich the network, okay? Thanks, everybody.